Hey everyone, hope you're having a good day. My name's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we'll dive in there, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com. We've got a Black Friday coupon code. It's called Black Friday, one word. You get 50% off the first month to try the community out, and you get a larger discount on the yearly membership. And if you're already a monthly member, you can always switch to a yearly membership for further savings if you'd like. So Kevin Carpenter, Charlie Munger, the great home run hitters do not remotely swing at every pitch that looks halfway good. They wait for one they can really handle. That's what great stock pickers do. So basically, investing is more or less sitting and waiting and waiting and waiting. Finding maybe a few great companies, watching them for a long time, and then waiting for potentially a market debacle or crash or recession to come along, and then investing copious amounts of money at a good time. That's kind of what Buffett's been, I think he's basically doing right now. Munger basically saying that if you don't know of a good company and there's no good entry points, well, then just sit in cash, is what they would say. And then if you find a good company or a good company goes on sale, that's when you sit there and deploy cash. It's almost like trading, but just finding a really good entry point. And I think basically what they're saying is everything is made on the entry. Buying something that is incredibly undervalued is buying it and making the money on the entry. Myself posting B of A investment clock, transition occurring between recovery and boom phase. So according to the B of A investment clock shown below, the equity bullish recovery phase of lower rates and higher earnings per share, which define 2024, will be followed by a commodity bullish boom phase of higher earnings per share and higher rates. So B of A investment clock 24, recovery to transition to 25, inflation boom. And this is what they've got here with the interest rates. So interest rates decline and they have EPS or earnings per share increase. That's a recovery phase. Then they think that rates are going to increase and earnings per share will go up. That's the boom phase. When things slow down, we'll have increased or high rates with lower earnings per share. That's stagflation cash. And then the bull flattening recession means that rates go down and earnings per share go down. And then you just continually go in this circle through this cycle. I also think that there are cycles within cycles within cycles. So you've got long-term cycles, 50-something year cycles. Think of that as the K wave. Then you've got shorter-term cycles, which is the real estate cycle. And then you've got cycles potentially within the real estate cycle that are more short duration. And that might be due to the stimulus that we got, that stimulus money that came into the system, ravaging all of that, quote, inflation. And then they blame it on supply chain shortages, but it's not really supply chain shortages when you increase the money supply as much as they did, give it to everyone, and then say, go buy crap. I mean, of course, the supply chain is going to be short in relationship to a 40% increase of money supply. Mike Zaccardi says, B of A, the fourth highest S&P 500 trailing 12-month price to earnings in the past 124 years. And that is a form of value. It's a valuation. So how much am I paying, which is the price, in relationship to the earnings that are coming off of the S&P 500. So 2021 was a peak. We had 1999. Here's 1921. And obviously, you can see it fall. I don't know if this is, this isn't correlated 100% with when the stocks exactly fall, but it is usually a precursor before they fall. So 21, 99, and 2021. And maybe we do pull back. I would be really surprised if we went to the low end here. I mean, that would be one heck of a move lower if we do that. There's a lot of risk here in the S&P 500. Metals weekly price and performance. Palladium performing the best, up 8% last week. Gold doing quite well at 5.5%. Platinum 3%. Silver up about 3%. Nickel up about 2%. The big losers of the week were uranium at -6%, manganese at -3%. Everything else is pretty much a wash in the middle. Homebuilders looking strong. So I've got the big move up in the 2000s. It peaked in 2006. The homebuilders peaked in 06. This is the crash that occurred all the way to 2008. So late 2008, early 2009. We had a housing market recovery coming on all the way up. And then in 2014, we started to take off and really start to move. We've been moving quite substantially the past week. This is or past month, I should say. This is a monthly candlestick. But you can see that we've been going up, 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 up. I think that we entered an expansion phase perhaps, or very close to it in 2020, but interest rates went up massively in 2021. And it's really slowed things down. So we'll see what it looks like going forward here. But when I look at this is not a bearish setup. Here's Leonard Corp long term, very, very long term. This goes all the way back to the 1970s. You can see the shoulder, head, shoulder peak in 2004, 5, and 6. It went on down, and the crash was 2008, which was actually over here. We had an inverted shoulder, head, shoulder, which is a bottoming pattern. Would have been a great time to be buying in 2008 and on the shoulder, and then holding this entire time. We've broken out of resistance, which has then become supports. We broke out, retested, and now we're running upwards and upwards and upwards. What does this mean? It means we're in an expansion phase. And if people deny it, I don't know how you can deny that, because you've got all the home builders going up. Well, maybe not every single one is making at all-time highs, but 90% are. And here is Toll Brothers. Toll Brothers, you had a big move in the 90s all the way up. You can see the clear peak in 2005. Big old pullback in 2006, 7, 8, all through there. We have a nice, good consolidation from 2008. We finally broke that in 2020. We did a retest in 2021, 22. And then we've been working our way on up. The expansionary phase of real estate generally throws off inflation. And that's when you get your commodity bull markets. And that's why it's important to look at this. Not many people understand this cycle here. Not a lot of people talk about it. Other people think that we're going to have a housing crash every 4 seconds, even though we have, depending on the city that you're in, there are a couple cities that are coming down because they've got a lot of inventory. But there's also a lot of cities in the United States that do not have a lot of inventory. You do not have crashes with no inventory. Coming down, we've got bull market for energy and other commodities will resume. So I've got oil commodities, bull market, heading on up where XLE was outperforming the S&P 500. We had the S&P outperform energy and commodities from the bottom of 2009 all the way to the bottom of 2020. We've got a bottoming pattern here. We've broken to the upside. We're in a falling wedge that I think we're going to break to the upside with. That's oil, commodities, and bull market, which is going to outperform the S&P 500. That also correlates with that clock that we were talking about earlier. It also correlates this 2020 bottom here. That also correlates with the home builders moving higher. That's the breakout that occurred in 2020, and then we're going into potentially this expansionary phase of real estate. And those are all interconnected. The thing that gives me an advantage, in my opinion, is that I understand the interconnectedness. Other people are going to tell me, well, what if this some other thing happens? It's like, well, guys, I've already stacked like 7 pieces of evidence against your outlook. And you have a possibility that you have made up out of your mind, but no data to support it. Now, could it go a little bit longer where this goes down? It could. It could, but the overall trend is higher. We have to be patient for the market to work its way on out. Now, in my opinion, and what I see, and I can tell you exactly where we're at, I think that 99 is equivalent to 2020. I think this move higher here is a big portion of this move in here. This downward sideward move is this guy here, right here. And then what happened in this time frame to get this big outperformance, that was the lowering of the dollar and the slowdown in the S&P 500 and NASDAQ. So the big move that occurred was from dollar weakness, and oil and commodities and emerging markets, they are priced in dollars. And emerging markets have different currencies that they're priced in. So when the dollar drops on the denominator, it pushes everything higher. And to understand all of that is absolutely imperative to the performance of an investor. You need to know what to look for and what correlates with what. Otherwise, you're just looking at charts saying, well, what about this? And what about this? And this is what's going to, you can't do it like that. You have to understand that there's an interconnected nature between all of these charts. And people interconnect a lot of this. The people in the markets trading. Coming back. So Heisenberg says inflation been creeping higher and higher since the September lows according to Truflation. So we've been coming on up. You know what that means? That boom phase is tied to the real estate market. The real estate market is also interconnected with energy and the S&P 500, and that is also interconnected with inflation in the system. And here it comes rising on up, and it's going to filter through gold. Gold's been going crazy. It's going to filter through oil. And if we are in that part, oil's going to rip. It's going to rip. Now, if we're in the wrong portion, and if all of us have that wrong, then oil may not rip and we might see other things occur. But we don't have evidence of that yet. So let's look at evidence. And there's more evidence down here that I will show. A quote from William O'Neill. He says, one of the greatest stock picking quotes of all time. Take your losses quickly and your profits slowly, because your objective is to not just be right, but to make big money when you are right. And that also lines up with knowing what I'm talking about, the interconnectedness and these cycles. It's about lining up the big move and then having the cojones to buy at the bottom and to hold it through the bull market, whichever bull market you're playing. The last bull market, which was from 2009, 10, 11, the bottom, all the way to where we are today, that entire phase, in my opinion, is the recovery phase of real estate. We just entered the boom phase or expansion phase of real estate recently. And some of that momentum can carry into the boom phase for stocks and NASDAQ and stuff. So I think that we're at the end of it. I think we're going to get a blow off top. It's going to roll over. And I think we will see a commodity bull market ensue here very soon. Canadian crude, maybe, just maybe, and this is a double bottom. It's a W bottom. We've broken out point A, and then we've come back. Point B is this support level, and we are still squeezing in this corner here. And this is Canadian crude index. I think that since this is a double bottom, a breakout, we're going to enter stage 2 here. And what that looks like is, this is from a book. I can't remember which book this is from. And this is a 30-week moving average coming on down. We've got double bottom. They've got volume on the bottom here, and then you've got a breakout as point A, B is the squeeze into the corner, and then the break higher. I think that we are in B, and I can show you evidence of why I think that because of positioning in other portions of the market. We have NARF here. So this is uranium, the Sprott Physical Uranium Trust, uranium estimated supply demand imbalance, or SRUUF. Well, not for that, but this is the imbalance. The imbalance is there. You can see there's a imbalance between demand and supply here, and it grows rapidly out into the late 2020s and early 2030s and onward. Huge setup there. Now, there is one thing I want to say. A lot of people look at this chart and they say, oh my God, uranium is going to go up so much. And then they go buy a bunch of uranium companies that don't produce any uranium. And I don't know when they're going to produce uranium. I still have exposure to it for sure. And I'm still in it with enough money that will make a difference. But just keep in mind that investing itself is about making money and free cash flow. And a lot of problems or issues in investing is when you step away from free cash flow. You get into the speculative side and things kind of go sideways a little bit. That's all I'll say. International Energy Agency, it says the world is set to move rapidly into the age of electricity. In recent years, electricity rose 2 times as fast as total energy demand. But from now to 2035, it's set to grow 6 times as fast, driven by EVs, air conditioners, AI, and more. Look at this. The world is set to move at a speed into the age of electricity, adding the equivalent of Japan's demand to global electricity use each year. We have a lot of electricity demand coming, guys. And there's a way to play it. It's called natural gas. Natural gas and coal are our short-term movers from 23 to 2035. I don't think nuclear is going to grow that fast. Not in the beginning. It will in a little bit. But I think nat gas is going to cover that gap. More and more confirmation of an early winter breakout on November 30th in the U.S. North and Southeast. Chicago F18, so that's Fahrenheit 18 degrees. Atlanta 24 degrees and Washington 26 degrees. And of course, where I'm at, we're going to be going all over the place. But this is good for natural gas. It's increased demand for natural gas in America that we're seeing here. Chevron very quietly breaking out of a plus 2 year descending channel right now. So it's breaking on out. What does this mean? Well, that's evidence that we've got a super cycle still in play. It's evidence that we were just in a consolidation. It's evidence that we're in a boom phase. It's evidence that we've got positioning in the oil equities. Chevron's not the only one. There's a whole bunch versus oil itself. So there's probably good likelihood that oil is going to go higher. And that all happens when home builders go up. It all happens when home builders go up. And what are home builders doing? They are going up. And that's money that gets created in the system. It flows through the system. There's more people in the system, too, of an age that's having kids, that's consuming more electricity, buying a lot more things. It's all interconnected. The dividend dominator says if you work 3 times harder as an entrepreneur, you might get 3x your income or even more than that. Who knows? If you work 3 times harder as an employee, you might get a well done. You know, that happened to me. I took on this huge project. I traveled a lot, spent a lot of time doing it, worked pretty dang hard at it. And it was a year-long project. We absolutely killed it. We beat all of our metrics. We underspent by over $1 million. I mean, we did everything right. And I was a huge pivotal part of the program and the project. I was on both sides. I was on the accepting side and I was on the transitioning team. And I got a bonus of $200. And I literally was about to rip it apart and be like, this is a joke, right? This is a freaking joke. And at that time, I was about 29 or 30 years old. Someone asked me on Discord, when did the ball drop for me? That was the ball that dropped. It was that exact project at that exact time where they lost me as an employee. I still worked there, and I worked there for a while. I just stopped taking on those harder projects. I said, nope, you guys didn't pay me enough. I worked real hard. We beat all the metrics. We I should have gotten something substantial there, and nothing. I didn't even get a substantial raise or a promotion, and I thought it was completely unjust. Now, if I wanted to continue to be an employee on the 9 to 5 route, I would have left and gone somewhere else, and that very well is what I probably should have done. But I didn't. I kind of just stayed and tried to figure out what my next steps were. But it took me a while to figure out what my next steps were. I did focus quite a bit on investing, but I also had kids too in my early 30s. So my 30s were more focused on kids than it was on myself necessarily or my job. So kind of just rode it for a little bit. Christine Guerrero says an inefficient energy creates a clear majority of jobs, but not the majority of power. So what powered the world in 2023? We've got oil at 32%, natural gas at 23%, coal at 26%, nuclear at only 4%, hydro at 6%, and other renewables at 8%. A total of 620 exajoules. I think that's what the unit of measure is. You got to keep in mind, though, this pie is growing. It's growing rapidly. So this mix could change. So even though natural gas is at 23%, it could go up in terms of its total usage, and the percentage could stay relatively flat. Now, I don't think that's going to be the case. I think natural gas can go way up, but coal could go down, natural gas could go up, and we'll see how much production we can produce of oil. I think oil is going to struggle at some point over the next 5 or 10 years, and it could be nasty. So we'll see what occurs there. The dividend dominator, okay, I already went over that last time. So we're going to end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We got that Black Friday coupon code if you're interested in joining. Everything's posted on the website. The question and answer session, all that stuff, it's all updated. The next one's going to be on a Sunday call at 5 p.m. But that's all I've got. We'll catch you next time. This is Finding Value.